with our main presenter. He will be sharing his insights on the crisis and its many components, complex structured instruments and systemic risks, public policy and regulatory failure, role of the government, inadequate governance and risk management, lagging capital charge treatment, and mark-to-market accounting. He will also discuss innovations that can be made on home financing-based securitization structures in the Philippines. And following the presentation, the discussion will be directed to our panelists. We're very honored to have our distinguished panelists this evening, and I will be your moderator. By the way, my name is Ian Lauron. I'm the co-regional director of GARP, and I'm with SUV. Our chapter meeting, by the way, commemorates the 4th anniversary of the 2008 US financial crisis. And incidentally, October is the housing month. So very appropriate or very timely to have this topic, which is really, I would say, a confluence of the real economy, which is on the housing side, and the financial market, which would be on more of the securitization and structured instruments. What I'll do is I'll introduce our speaker and then our panelists. So right after the presentation of our speaker, the panelists will be providing their insights and their perspectives on his presentation. They need not be covering all facets of the presenters or speakers' presentation. And after the panelists' turn, I will be moderating a Q&A, and that's where the participants, we're very happy to have you here, despite the very excessive liquidity out there. We thank you, somewhat symptomatic of our capital markets and banking sector. I hope you will be still coming over for our future activities. Just very quickly, Global Association of Risk Professionals, or GARP, is the body that administers 2 certification programs. One is the FRM, or the Financial Risk Management Program, and the other is the ERP, or Energy Risk Professional Certification Program. If you're interested to learn more about this, feel free to approach us after the meeting or visit our website at garp.org, GARP.org. Our main speaker is a retired banker and retired auditor, my mentor and lifelong tormentor. He introduced me to the world of finance when I was his student in the Asian Institute of Management. When he was in AIM, he was the executive director of the Governor Jose Fernandez Center for Banking and Finance, was on the core faculty of the WCC Graduate School of Business and Executive Education and Lifelong Learning Center, where he is the program director of banking and finance-related programs such as the Finance for Senior Executives, the course for Senior Bank Managers, and the Asian Bankers Association AIM Bank Management course. He handles the risk management and asset liability management modules, financial management subjects, and electives in financial policy and strategy, management of banking institutions, and portfolio management. He was involved in lead capacities in the AIM's Master in Management program, Master in Development, MDM program, Master in Entrepreneurship, an area of excellence for finance and economics. His research interests are in the areas of privatization, local government financing, strategic use of IT in banking, and behavioral finance. He was president of the Asian Consulting and Training Group, and he is a CFA charter holder. He became the first president of the Association of Investment Professionals Manila, the local chapter of the CFA Institute in 1988. He also served as the founding regional director of the Global Association of Risk Professionals in the Philippines. He was seconded by AIM to the Land Bank of the Philippines, where he served as executive vice president of the branch of the banking sector. He was also managing director of Pricewaterhouse Financial Advisors Inc. He holds a Bachelor of Science in Chemical Engineering from the University of the Philippines some time ago. He received a Master in Business Administration, major in Accounting and Finance from the Columbia University, and a doctorate in Business Administration, major in Business Economics from the University of the Philippines. Some more recent updates, he is also a certified ERP, Energy Risk Professional, and independent director of WESEL, and is now the president of the National Home Mortgage Finance Corporation. Please welcome Professor Felix Bustos. Sir, sit here. And I'll introduce our panelists. Our first panelist, he finished his AP Economics degree at the De La Salle University. He started his career with Ayala Investment and Development Corp., now BPI Capital, where he held various positions covering research, corfin, and fixed income trading. And then he moved on to BPI, or Bank of the Philippine Islands, wherein he held in various capacities or positions as, in such groups as the Investment Banking Group, Treasury, Consumer Markets. He was Vice President, Deputy Treasurer of BPI, Senior Vice President and Group Treasurer from 1989 to 1995 in BPI, wherein he also concurrently held positions such as Chairman of BPI Securities, Treasurer Director of BPI Family Savings Bank, Executive Director of BPI Capital, Treasurer Director of BPI Credit Card, among other entities within the group. He was President and CEO of Banco Santander Philippines, and since September 2003, he is the President and Chief Executive Officer of Philippine Dealing Systems Holdings Corp. He concurrently holds the position of Chairman and CEO for Philippine Dealing and Exchange Corp, or PDEX, as we all know it. Also PDTC, or Philippine Depository and Trust Corp, and Philippine Securities Settlements Corporation, or PSSC. Please help me welcome our first panelist, Mr. Vicente Teng Castillo. Our second panelist is in the core faculty of the Washington CISIP Graduate School of Business of Asian Institute of Management, and his expertise is in asset-backed securities analysis, credit rating, and project financing. He is AIM's JV Ongpin Professor of Public Finance. He teaches analytical finance topics, including ABS, or asset-backed securities, credit rating, and project financing. He led the launching of AIM's health management courses and has provided consultancy service in the areas of health policy and health systems financing to the Department of Health, the Philippine Health Insurance Corporation, and various multilateral agencies that include the Asian Development Bank, CIBA, and USAID. As such, Professor, or our second panelist, he previously served as Deputy Team Leader for the Philippine Health Sector Agenda and a Healthcare Financing and Policy Specialist for ADB and USAID, respectively. He is currently President of the Credit Rating and Investor Services Philippines, Inc., or CRISP, a private corporation that provides credit ratings on asset-backed securities, corporate bond issuers, and risk assessment services to debt issuers and investors. The company is one of only 2 accredited credit rating agencies in the Philippines by the Securities and Exchange Commission. He currently leads the Center for Legislative Development, an independent non-government organization that provides policy development support for the Philippine Congress and policy groups. He is lead convener of the Health Policy Network, a loose network of healthcare interest groups and individuals. His international experience includes a stint as a credit rating specialist at Standard & Poor's in New York, as an assistant professor of public policy at Long Island University School of Business and Public Administration, and as lead analyst for Federal Healthcare Financing System at New York City's Health and Hospitals Corporation. He earned his MBA, or rather his Master in Public Administration degree, from Harvard University's Kennedy School of Government, where he specialized in public finance and public policy. He also has a Master of Arts from Columbia University's Teachers College and obtained his Bachelor of Arts from De La Salle University. Friends, please help me welcome Professor Emmanuel Noel Leico. Before we start with our presentation by our main presenter, Dr. Bustos, it is my honor to also acknowledge the presence of the following distinguished individuals. We have the CEO and President of CIC, Mr. Valen Liga, Sir, thank you very much for coming. Also, we would like to acknowledge the presence rather, of Director of the Board of Directors of Metrobank, Director Rene Valencia. Sir, thank you again for coming. All our friends from, especially our interest groups, SGV and National Home Mortgage Finance Corporation. May I ask our friends from these two companies to please stand? I just would like to know whether we are reaching 50% of the crowd. Please. All right. Wow. We did not force them, by the way, to come. They are our cheering squad. Also friends from ADB, BSP, also from the academe, from the banking community, and also my fellow partners, Wash Roqueza and Janet Nunez. So with that, thank you for taking the time to listen to our introductions. May I now call on Dr. Felix Bustos.
I guess I will not repeat all the names that I have mentioned, but they're all good friends, and I'm so glad that they're here to give me some moral support. Anyway, I think it's called for now when you deliver a speech in the Philippines that you give acknowledgement or you borrow certain things. So I will start with that because I will not be accused of being like certain senators. So the first part of the speech was actually delivered twice. Okay, I was corrected by Ian. I put it down 2009. It was actually delivered first in the 2008 convention of the PICPA in Davao. Okay, 2008, right after the U.S. national crisis, and then it was delivered again. It is there 2009 at the GARP, that's the Government Association. Thank you for the correction. But what I try to do is I try to simplify it a little bit and make it less critical, because for those of you who watched the earlier film, I so empathize with that guy who's bald-headed with a lot of Ben Bernanke. It was actually the one who replaced the leading character. Siya na ngayon he's now the Treasury Secretary. Why? Because once upon a time I was also similar to him. I studied the Philippine crisis. There's a book in the AIM. It's available in the library called Responding to the Uncertainty. It's an analysis of the 1997 Asian crisis. And then obviously I extended my research to the US and global crisis. And that's why I volunteered, or actually Ian volunteered me to deliver, to talk to the Big Bang GAPA in 2008. But like I said, since I'm now more or less like Bernanke, I sort of tempered this first part down. The ones who were there, a lot of CPAs, so they probably saw the original version that was more aggressive, more, well, different, okay? So this is just, I just tried to more or less stick to definitions and interpretations so I can use some of the terminologies later on in the second part. Okay, I'm the most non-technical person. Oh, by the way, I should acknowledge another person. My daughter is an investment banker. He also has an MBA. And one of the first things he said when I accepted the return to government in January of this year is that, Papa, make sure you don't lead us to the Philippine crisis. Okay, so I guess the second part will more or less assure her that I'm not going to replicate what happened in the first part. Okay, so I had to mention that. Okay. Okay. Before we start, there are no pre-dinners. Okay? So you have to give an answer. What do you think? Yes. What do you think is a reasonable leverage ratio for financial institutions? 5 to 1, 10 to 1, 50 to 1, 100 to 1. 10 to 1, okay, according to our Australian banker friend. Anybody else? 10 to 1, okay? So 10 to 1 seems to be a popular number. The answer actually, if you look at the US 2008 system, it was more none of the above, because their average was 400 to 1,000. This is a basic 5 C's of credit question. Does the quality of credit matter? Yes, no? Obviously, the answer should be yes, right? This Professor Bustos tends to be tricky. Probably say no. Obviously, as what happened in 2008, the answer is no, right? And you'll get more details later on when we go to the specifics of the things. Anyway, first some background. Like I said, like Ian said, we're celebrating, commemorating the 4th anniversary of the U.S. financial crisis. So I will bring you back to 2008. Okay, so the U.S. housing industry in 2008, they have very low interest rates. Mortgage brokers, they're the people who try to bring loans to the banks. We're geared towards generating volume. And those who saw the film saw that, okay, because the banks were making so much money. Okay. And as they were saying, because they've already securitized good loans, they were taking even the bad loans, because quality assessment fell down. Okay. And because of all of this, a new word entered English language. Okay. Those were the so-called subprime mortgage. The prime was always there, okay, but they sort of put the word sub to make it opposite. Like prime is good, right? Like Ayala is prime account, so they came up with the opposite, subprime mortgage. So what are subprime mortgages? Okay. Investopedia defines it like so, okay? Monthly mortgage payment, again, I know this data. Senator Anopo. This came from Investopedia. Monthly mortgage payment in subprime mortgages are greater than the bank's disposable income. I guess that's where the term ninjas was used in the US, okay? Ninjas means no income, no job. All that type. They were given loans because the expectations might have been that eventually their income will rise in the future. A second characteristic, the amount of loan granted versus the value of the underlying collateral, what bankers call the loan-to-value ratio, was very high. Okay? Expectations might have been eventually the denominator or the value of collateral rise in the future. Okay, and the third is that the mortgages were made feasible, despite wanting to buy what are called teaser rates, which are really very low and fixed at the early stages, and then they become variable with very high spread over benchmarks in future years. Again, to be fair, the expectations might have been that both events 1 and 2 will occur, and interest rates will remain benign. Okay? So that's the first definition. Okay, subprime mortgages. Let's abbreviate them as SPMs. Okay. Next definition, and we'll do it by drawing, is something called mortgage-backed bonds, abbreviated as MBBs. Okay, and to define them, you have to start from the bottom and move up. Okay, at the very bottom are a cluster of SPMs. SPM1, SPM2, so that's the underlying, and then these are pulled by so-called loan originators, and then they sell them to investment bankers, Wall Street, and they do all sorts of enhancement to look up later on, and they become a new animal called mortgage-backed bonds. Again, that's definition. Abbreviated MBBs. Okay. They're supposedly better because of the law of large numbers. SPM might be bad, but assuming you pull a lot of bad credits, but they probably won't all be bad at the same time. So if you pull a big enough number, then maybe the resulting aggregation will be a better instrument. That's the mortgage-backed bond. Okay. The next instrument is something called collateralized bond obligation, abbreviated CBOs. Again, you look at the bottom, going to the top. Okay? At the very bottom are something we met earlier, mortgage-backed bonds. Again, you aggregate all sorts of mortgage-backed bonds, you put them together, lo and behold, you come up with a new animal called collateralized bond obligation. Okay? CBOs. Again, we will use them in the next animal, next instrument, called collateralized debt obligation, CDO this time. Okay? And again, at the very bottom is something we met earlier called CDO, which are taken by Wall Street and converted into, again and again, into something supposedly better because, again, of the law of large number, the actuarial statistics. People here will say, okay, if you have a lot of these things, even though there might be a probability of default, but if you put them together, eventually some of them will probably pay off, so you'll be able to support the obligation on top. And what more, they do some enhancement on top to make it even higher grade. Those of you who came earlier and watched the film Too Big to Fail, one of the things that they did is they got insurance companies like AIG, to give credit to all insurance, CDS, to make them, even though the underlying is subprime, at the end on top they became prime. Okay, so by all sorts of structuring, all sorts of statistical manipulation, even though the underlying 3 slides ago was a subprime, lo and behold, you come up with something super prime or CDO. Okay? Anyway, just those are all. Okay? The question obviously is the CDO in itself bad, evil? Okay? No. So there's nothing sinister about the structure. In fact, it's kind of clever. You're able to take something which they had so much of and come up with something that was very marketable and lots of people were looking for it. Okay? At that time, it was very benign. Even though they were subprime, the interest rate was very low. It led to greater demand for houses and therefore increased housing prices eventually. And so some of the problems cited at least. Okay? And CDOs were very marketable in Wall Street. Okay. Okay, why was Wall Street so keen on CDOs? Well, as mentioned, but there was right after the Great Depression, 1933. Actually, that was the doctoral dissertation of the current Treasury at Bernanke, looking at the causes of the first U.S. crisis, the Great Depression in the 30s, is that the banks were taking risks that did not appropriately relate to bonds, mostly investment banking. So in 1933, the U.S. Congress passed an act which made you decide, are you going to be a bank, are you going to be a commercial bank, investment bank. That's why if you notice, you were looking at the bank, you notice that there was one word that kept being mentioned, and that was Morgan. There was a bank called JP Morgan, there's an investment called Morgan Stanley. So once upon a time, these were all together, and when they split them, okay, the name was still there. Okay? And non-banks, particularly investment banks, enjoyed spectacular profits in the late 1980s, and they wanted more income sources, so they lobbied, and they were able to get it repealed in 1999. Okay, and investment banks now face competition from commercial banks because commercial banks also were now allowed to do investment banking business, so they had to look for other sources, and therefore the fees from packaging mortgage-backed securities and CDOs presented the opportunity for the investment bank facing competition from the commercial bank. On the other hand, also, the commercial banks were also given opportunities because they could now hold the super prime mortgage-backed securities. I won't go into it in much detail, but because of certain regulations of banks called Basel I, Basel II, Basel III, it very attractive for a bank to hold something which is rated low risk, super prime, and yet it's giving you some prime return because it does not require any risk capital. So it was apparently a win-win situation. Okay? The investment banks were getting fee income, and the commercial banks were able to book the income from this very attractive CDOs. Okay? Okay, why did the investors, the man in the street, buy securities backed by subprime? And I'm sure they're disclosed. There's one thing the U.S. very good at is disclosure. Okay. Well, it was structuring the drawing that I made earlier. Okay, and the enhancement, like insurance, increased the investment grade on the super senior portion. Okay, who said it was now super safe? They had third party who never worked for the bank or the investment bankers called rating agencies, and they rated them AAA. Okay. In general, mortgage-backed securities with investment grade and higher yields than corporate bonds with the same rating because they were getting high returns at the very bottom. Okay, so it looked like it was very good. So they were making a lot of money in the 80s and 90s. The market was very high. Okay. And interest rates, as usually happens, it goes up. It follows Newton's law of gravity. Sometimes it also goes down. It also goes up. Interest rates increase, right? And the subprime turned out to be subprime, right? Because if the interest rates are very high, your borrowers cannot pay the interest rates. And then the houses, instead of the value increasing, the value went down. Okay? And CDOs, even though they're structured so that they're AAA, defaulted, right? Because the cash flow for payment, even if you go down, eventually comes from the very bottom, the subprime. The subprime are not yielding cash. There's no way you can pay the MBB. The MBB cannot pay the CBO, and the CBO cannot pay the CBO. Okay, so they had problems, and then the insurance have to be called in, and enhancers of the bonds and CDOs and their capital eroded, and everybody could not pay everybody. So as you and what's up earlier, everybody was in state of panic, and that's why the government had to step in with all sorts of support, which they said they would not. Okay, anyway, that's water under the bridge. But as usually happens with something like that, there's usually asserts for parties to blame. Okay? And lots of excuses came about. Okay? First, the loan originators. Well, you say, well, we disclosed, like I said, the U.S. is very good at disclosure. We told everybody that the underlying was subprime. I guess you could probably say, yeah, you told the truth, but did you tell the whole truth? So honest were you in the documentation. Okay. Wall Street, who packaged this thing, well, we trusted the originators. Okay. Question mark. What happened to due diligence? Okay. What sort of review did you do? Okay. And the third companies that I mentioned earlier, the rating agencies, the AAA, those are very complicated. I have to look at all the subprime, I have to look at all the MBBs, I have to look at all the CBOs, and I have to look at all the CDOs. You don't pay us enough, right? To check each and every single part of them. My answer would be, you should not have taken the job. But that was me when I was still a professor who wanted to make something. So I looked at certain people who are more experienced and more objective. So I looked at 3 Nobel laureates. One was Edmund Phelps. His take on the subprime crisis, obviously, was caused by overvaluation of assets and financial instruments. Banks exported the crisis to the rest of the world through financial instruments which were marketed globally. You can see the finance minister of France was calling the finance minister of the US. By the way, that lady is now, I think, president of World Bank. subprime is ancient history. Focus now on making sure there's cost reserve. Okay, sounds familiar to Philippines, right? We have lots of cost reserve. Okay, that's what Basel III is pushing liquidity. And we need a competitive banking system with government insured deposits and assets in the bank must be tightened. Okay? And I looked at the third Nobel laureate, his name was Richard Selden. He said regulation is important, markets cannot analyze complex securities correctly, put more regulators and be tight about it. Okay? That's what they said. When we were looking at it the first time, we had just passed our FRM exam. We were handling a review course, and our take was there is failure in three major areas of risk management: credit risk, market risk, operational risk. In credit risk, I started using all the terms that I just practiced. At loan origination, PD or probability of default was willfully lowered by the originator. At CDO packaging, probability of default of funds were incorrectly estimated, intentionally or intentionally, I don't know. At the CDO squared, okay, which is the higher level, the loss given default estimates and incorrect correlations were used. Okay. In terms of market risk, everybody was saying, really, interest rates are not going to rise soon, and CDO market is too small to have a severe impact on the finances. Okay. And then in terms of the third, operational risk, loan originators, very bad incentive, Wall Street has bad incentive, rating agencies have bad incentive. That's why everybody now loses the payroll and all sorts of incentive. Investors trusted all the three. But I guess looking back now, I think perhaps I should not have looking at them individually, I should have looked at them collectively. And say the risk silos, you don't look at them individually, they're all connected. Okay? The bad incentive to the loan originator led to the past due being lower than origination. At the next level, incorrectly low past due ratios was reinforced by interest rates are not going to rise soon forecast, which is market risk management. And altogether, the Wall Street rating agency investors only to readily accepted, this is operational risk management, that interest rate is not going to rise. Okay, that's what I said right after that. But now having had more time and done more reading of other books, including one that is the most widely read book in the world, I feel that my take is probably different now. Everyone who uses words of mine and does not do them will be like a foolish man who built his house on sand. And the rain fell, and the floods came, and the winds blew and beat against the house, and it fell, and great was the fall of it. Essentially, after looking at all of that, I think the underlying was that all of this financial structuring, all of this wonderful financial engineering was built on subprime. No matter what credit enhancement you do, no matter what you do, when the interest rate fell, the multi-crisis fell, the house of cards came tumbling down. That's one of the best-selling books in the world. So, end of part one. Okay, this is something that is a product of my 8 months of government service. I was enjoying my retirement, I was enjoying driving a school bus, and suddenly last Christmas I could not say no anymore, so I went back to government in R18. And I was like that guy, remember that was suddenly put to head something which is very similar to my two favorite books, in the negative sense, U.S. agency, the Fannie Mae and the Freddie Mac. I really hated those two. And then suddenly, lo and behold, I became head of Fannie Mae and Freddie Mac of the Philippines. And that's when my beloved daughter said, okay, Papa, make sure you don't do what they did in the U.S. So anyway, here's what I did. Maybe you can tell me later in the question and answer whether I did it correctly, and therefore I will prevent this happening. Although I would like you to know I had practiced this morning. mandate of the National Home Mortgage Finance, which is what I head, is securitization. And essentially, securitization, again, I will acknowledge some people. One of them is Professor Bicklin-Bingan, good friend of Professor Lake and myself. Had a very simple definition. He says, it's just separation, transformation, and multiplication. Separation, and you isolate the assets from the banks, and then you transform them into marketable securities. And by doing it very fast, in the US they can do it 8 times, you do the multiplication. So the same 1 million in loan can actually become, by process of engineering, 8 million in loan at the end of the year. Okay, in drawing, you get a portfolio of assets, that green drawing, and then you you buy it from third party, and then you go to a special purpose trust, and then you get a financial underwriter to convert it to a marketable securities, and it's like putting a new paint job on a used car. You get third party to do some credit enhancement, and then you're able to sell it to investors as a marketable security. Okay. But the first party is really the source of the asset that becomes the asset pool. And in general, the originators are banks, okay? Because they have a lot of the loans, large local corporations that have receivables that they might want to sell. In the example there, the JD Corporation. You can have leasing companies, finance companies. You can have property companies and REITs. Probably a good topic for the next meeting. Multinational companies, because usually multinational companies have sovereign limits. Okay? Just like Citibank, you have a sovereign limit of 2 billion for the Philippines. Once you reach your limit, you really can tell your client, Citibank can no longer give you a loan. So what they will do is they will securitize the bulk of their loan, and they will get more cash, and they're able to give more loans to the client without telling them that we're actually just recycling your money. That's what. And government institutions sometimes to get rid of some of their assets, or they want to advance some cash flows. A good example would be perhaps the Palawan. I don't know who owns those natural gas anymore, but they have sold the natural gas forward so that they can get the money. They can do projects without waiting for all the cash flows from the who are the investors. Usually private institutions, insurance companies who need long-term sources, private pension funds, asset management, hedge funds. Okay? And in the Philippines, there are government institutions, led by my good friend in Evelyn before SSF, DSI, NHMF, government financial institutions, provident funds, and banks, and other financial institutions who would like other sources of funds. Not just loans, but investment, because like I said earlier, if an investment is rated low risk, then it doesn't take any of the risk capital. And that's because of some rules called Basel I, Basel II. Okay, what are some of the things we need to do securitization? Okay, most important thing, and this is very lacking in the Philippines, and I'm glad Val is here, is you really need historical information to analyze the performance of certain assets, certain borrowers. Okay? Historical data, payment history, receipt value, collateral. Like a good professor, before I assume, I asked the Vice President to send me to Washington, and I visited those good institutions, Anime and Fatima. And the way they process loans and convert them to marketable security is like an assembly line. Okay? 8 o'clock in the morning, they have bundles and bundles of folders. Okay? And by 3 o'clock, they're able to triad this into 3. Good for securitization, not good for securitization, and maybe some credit enhancement. And they're able to do this because they have a lot of things which we're aiming to do, but we don't have it. they don't have to do the title check kasi they have title insurance. Parang it's our own scriptless trade. And we don't need to punch in. So they have that. And when they need the loan valuation, okay, they just type the zip code number and 2154 and then the 460. And then within a mile, they know the value of the property and the credit bureau. They just type whatever and they're able to get. Remember they were talking in the movie about prime used to be 660 credit score. They went down to 500. You can get that easily. Type the name of Noel Leco, you'll see Professor 500, then Castillo, check to be 700, things like that. They can get credit rating very quickly. So here it takes longer. My gut feel is we can do a securitization in 5 months. So in the US, they usually give you the turnover 8 times a year. So that's roughly about a month and a half. And something, that's an average, something we even faster. So that's some of the things that you need. And then, once you get all those data and you come up with a plain vanilla, then you start putting in the paint and the oil, etc., the credit enhancement. Okay? You get the asset pool and you make sure that the marketable security that you're going to issue is a lower spread. Okay, I'll give you an example when we go to BB1 and BB2 later on. You over-collateralize, make sure there's enough collateral, more than enough to support the marketable security, and then you trans the notes under A, B, or C, so there's subordination. Okay, so cash flow from asset pool can be transferred to current account. And then you can set up reserve bonds, special accounts, so cash is pre-deposited, so the initial interest and other expenses are set. So in case typhoon happens, tsunami like in Japan, for example, if you had what BB2, the interest rate for the November 17 thing, I think you'll be happy to hear this. The interest rate for the November 17 interest rate is already deposited with trustee. That's a reserve fund. And then hopefully you put all of this together, you get a higher credit rating from somebody like Noel Leco. And then to make it even better, you get a letter card from a bank or guarantee from somebody like HTC or C-Rating. Okay? So those are some of the things that you can use to come up with a very nice security which converts loans into very good marketable security. Okay, I mentioned something tranching. Essentially what you do, on the left you have all your assets, and then you say some are not good, so you have the asset pool, which is the ones that are good for securitization, and then the cash flows, you say I will pay the senior notes first, those are the yellow ones, and once they're paid, I will pay the blue ones, and only after I pay the blue one do I pay the bottom. Usually, the bottom one is retained by the issuer. And if you want even higher rating, then you set up special conditions. There will be an early amortization in case certain things happen. Then I ring fence certain assets so that there is a bankruptcy and you take special conditions. And you put them in a special course. And then you put in all sorts of credit enhancement. Those are the cookbook, the recipe from which you can select. Okay. I didn't necessarily do all of that, but I just wanted to introduce it. Anyway, again, some more background. What is this NHMFC that I'm heading? It was created in 1977. We're celebrating our 35th year this year by President Felixberto December 21. Its mandate is to be the major government secondary mortgage institution. That's why we were able to do the second one after 35 years. Mandated to operate a viable housing finance system by enhancing security. We have a board of directors, super high caliber, chairman is the vice president. The members are the central bank governor, secretary of finance, secretary of budget, and yours truly. We have a program. The details are in our website, nhmfc.gov.ph. Was attacked by hackers this morning, but we turned them away. We had very good about our programs, you can find out about the portion where we buy loans for securitization, for housing loan receivable program, and you can find about the features of the funds. Okay? Anyway, that's by background. Okay, let's look at essentially the two mortgage-backed securities done in the Philippines. Okay? First one was done while I was still in the critic stage, roughly about the time that I was delivering the first things in Tampa. It was done in 2009. Okay, loans at the conservatory, very plus Peninsula Manila. Okay, the underlying pool was 12,000 prime residential mortgage, and based on that, they issued over 2 billion worth of asset-backed securities. They were tax exempt, whatever, under Section 31 Securitization ATC guarantee, they had both. Under Section 31 of the Securitization Act, if your underlying asset pools are socialized or low cost, then you're supposedly tax exempt. Okay? But there are certain people who question this. I won't give you name, but her initial is KT. The BB1s consisted of 2 classes of notes. The Trans A was rated AA by Phil rating. It was bought essentially by qualified institutional investors, basically 3 people, 3 banks, Land Bank, Banco de Oro, and RCTC. And the subnote rated BB Plus was retained by NHMFC. Okay. What sort of enhancement did they include? There was home guarantee corporation guarantee. Like I said, it gives you tax exemption, but they didn't really need it, but they got it because it provides a guarantee for the asset pool. The market reception was very good. It should be, right? The interest rate was 8% tax-free, so that's actually 10%. It was twice oversubscribed, and it was lo and behold given recognition by the Asset Asian Awards and awarded the AAA award category 2009. Securitization of the year. That was the first one. Okay. I was not there. It was also not listed, so Teng was not there also. This was the structure. The originator was NHMFC using our own borrowing. PNB was the special purpose trust. Guarantor was HGC. The trustee was EBP. Preservation Agent Standard Charter Bank. Very expensive. Investors RCBC, Land Bank, EBP. Standard Charter Bank. Of course. Land Bank is cheaper. That's BB2. Not being everything. But still only BB1. That days were very stressful, etc., etc. Okay. Unfortunately, the president at that time decided to resign, other things. Probably reviewing now is taking the law exam beginning Sunday. We will have a 1-minute prayer for it later on. For the next 4 Sundays, going to take the law exam. Anyway, between his leaving and my taking over, there were certain things that came out. One is BSP did a very comprehensive consumer finance survey, very big sample. It was released April 12th. We were packaging the BB2. And I think one of the major things that came out is 8 out of 10 households in the Philippines, 80% did not have a deposit account. This is a big sample, for retail, big sample. Less than 1% of the households had investment stock, mutual funds, and even though it's in the website of the BSP, even though they have appliances, they have jewelries, etc., iPhones, etc., they were not willing to make investment because they were afraid, right? Because you have to remember, a lot of these people, some of you are very young, some will remember something called agrics, things like that. Then some of you very well, or even younger, will remember something called what's the bank that used to be headed by Mr. De Los Angeles? Okay, well, things like that. So they got scared. I suppose that's why. By the way, Mr. De Los Angeles was also one of my predecessors. Okay, that's one thing. Okay, it obviously, because of that, it altered our perspective. Another thing that came out, the central bank decided to implement a rather old circular number 600, which was approved in 2008. Okay? 2008, the central bank said, okay, thou shalt not loan to a sector beyond 20%. Okay? But the initial definition, when they said thou shalt not loan, it's a basically plain loan. Okay? So, for example, if you're looking at real estate, they look at your real estate loans divided by your total loans. If you're 20%, stop. Okay? But in a statement release of 2012, they had supplementary rules. Okay, so now in the numerator, the denominator is still the same. The denominator is still your total loan. But in the denominator, they will now include all loans, okay, including socialized housing loans. That's been accepted before. Focus loans, investments in debt, so that will include investments in BB1. So Mr. RCBC, Mr. Banco de Oro, and Mr. Land Bank would now have to include the BB1 investments in the numerator and all future investments there. And equity security is related to real estate. So if you have Ayala land, if ever comes to pass that we will do a REIT, it will be in the numerator. All loans related, all activities related to real estate are now in the numerator. Okay? So, based on the presentation, I was in Davao last week, or I think we're now in the high teens. Okay, 17, 18, something like that. So what we're seeing now is if we just rely on the traditional sources of real estate loan, it's quite limited. Okay, the banks can only give another 50%. And to implement the new rule, BSP is requiring all universal, commercial, thrift banks, and the trust department, okay, closing that loophole, to submit a quarterly expanded report on real estate exposure and solo and what's already in place. The first report should be due by the fourth quarter this year. So, the bank said bank's real estate exposure will also be referenced against adjusted capital, single borrower's loan limit, etc. All of this because they probably watched that horror film that Ian showed us earlier, where the banking system would go down the drain because too much exposure to real estate. But they said, consistent with sound risk management practices, which espouse the maintenance by a bank of adequate capital that's commensurate with risk. Okay, and finally, by BSP definition, real estate activities are now very wide, includes construction, development, ancillary services like buying and selling, rental, management of real estate property. This is a very much wider definition than the original circular, which limited real estate activities, acquisition, construction. So that's one thing we were thinking of. So that when we design the buy band 2, which we call BB2, everybody was teasing me and said, I think that's probably Binay Bustos. Just happens to be my chairman. My last name just happens to be Bustos. The concept we decided is that we're going to be retail, and we will focus on our mandate. We will focus on local socialized housing so that it will be tax-free, and we will make sure that there's a lot of transparency, and the best way to make it transparent is to make sure that Castillo's looking over my shoulder. It's listed, it's like you're listed stock company, you have to make disclosures. Okay? I go to the toilet, and I have to make disclosures. Okay? So that's forcing me to be super transparent. Okay? It was going to be, we thought, first ever retail market. But let me tell you, I wasn't really very high, very comoda until somebody treated me to lunch. Maybe you'll tell the story later on. It's a vegetarian lunch. I thought I was going to get steak with vegetarian lunch. And he told me the advantages of being listed. Anyway, with all these inputs that I got from history, from what happened between BB1 and BB2, the advice from people, okay, we came up with our, okay, it was, we started purchasing very good loans under our HLRPP, we decided to get very good but value for money servicing people like non-bank trust, DBP, PDPC, because it's retail, right? You can't afford to pay multinational investment funds. So we believe that's the structure. And I'm for their here and I'm endorsing them, even though they don't charge an arm and a leg. They work very late and we do up to the end. Okay. What are some of the specifics of the things that we do? Okay, obviously, what goes in first at the very bottom is the asset pool must be good. Okay. So we put in current and performing housing loans, okay. Basically the lowest one. Okay. Outstanding value was 603 million, and we made sure that these were really the ones where they're not really very big, where one can affect the cash flow. Okay, so 61% were those paying less than 3,000 a month, and 39% were paying 3,000 to 6,000 per month. Okay. The weighted average seasoning was 9.66 years, meaning they already have been paying for close to 10 years. It's pretty good. Studies have shown if you pay for your house 2 years, generally you probably will not get it for 10 years. And if you want to make sure they keep paying, even though the term of the bond is only 5 years, the weighted average remaining term of the asset pool is 8.83 years. Okay, and we wanted to make sure they would not walk away. The loan to value ratio, like in the US, was a very low 30%. Okay, so we put all of that together with the help of our very good financial advisors, like Bank of the Philippines, who then now are set up based on their credit models, etc. We have a very low probability of our borrowers not paying amortization because of all of the above. The appraised value is very high. They've been paying it for so long. They have so much to do. Okay, that's the first picture. Okay, and then given that, then we did all sorts of things. Okay, make sure there's a tranching or subordination. Okay, again, these numbers came from the land bank credit model. Okay, so 50% of the asset pool will be used. The asset pool will be used first to pay 50%, which is the Series A, 300 million, was paying 4.8%. 20% will be the Series B, paying 6%. Okay, and the residual 30% will be Class C. Okay, if I tell you the average asset pool was paying 10.4, okay, 30% was 4.8, 20% was paying 6, and 30% is X. Remember your algebra, you will find that the C, if everything gets paid, would have paid, let me look at my spreadsheet. I did my algebra this morning. It would have paid 22.67%. So this, theoretically, if everything gets paid, you get 22. Even though we were planning to keep it, a lot of people started calling me up. But like a good boss, I said, I'm a good commander. The one that makes decisions is my subordinate. So all these calls got channeled to the Vice President basically like, so if you're interested in returns of 22.67, don't call me. Things is over there. She's hiding, but I will make her stand up later on. 22.67. Anyway, very, I thought, pretty good structure. Actually, if we wanted to sell all, we would have gotten all of our money. And perhaps we would even have gotten more than the asset pool because this would have sold more than actually, well, we'll get to that later on. Even the A is now selling more than par. Okay, we also set up some liquidity reserves. We make sure there's excess spread. Like I said, the asset pool was earning average of 10.4. Series A was making 4.8, Series B was 6, and Class C gets the residual. Theoretically, if everything gets collected, Class C will get 22.67. Okay, we subordinated then, Class A gets paid first. And we wanted to make sure the Class A was very attractive and very, because we were planning to sell that to the 80% of the Filipinos who did not have things. We had a sinking fund, okay, set up in a separate facility, and we got AGC guarantee, even though we actually did not need them for the tax because our collateral was low. We also had liquidity enhancement, like I told thing earlier. Even if we have a triple disaster like Japan, and I cannot collect on all the asset pool, by November 17, we can pay for the first interest because we have already set up the amount to pay the first 3 months of interest. Okay? It's already there. It's not with us, it's DBP ratified. And even more than that, we also set up 9 months worth of payment for everything. So essentially, we make sure that no matter what force majeure happens, because it seems to be a lot of force majeure now, right? Maybe we should start reading that famous book again, the section called Revelation. And we can take that in another time. And then we also had other features. There was a clean-up call. We can exercise the clean-up call when the outstanding balance was below 10, if they have been prepaying, or when the outstanding principal balance falls to less than 10%. We were amortizing using the controlled amortization method, even though we're paying interest on the payment. So this, all this buffer were not going back to us, it was going to the trust. So I thought, given all of this, okay, we had enough features to make this Class A very attractive for our countrymen who no longer trusted the regular finance. The asset pool was seasoned, performing. There's a spread protection 364 a month with all the liquidity reserve. The Class C was variable interest rate. It was put in restricted, but in a shortfall. And the Class B and C principal cash flows can support the principal payment. It's a 50-50 of Class B. Subordinated Class C of 30% will only be paid out after Class A and B have been fully paid. So even if it's 22.67, you have to wait until A and B. And there was, like I said, HTC guarantee. But we were not contented, at least for Series A, we decided that we will also list it. It's the first retail mortgage bank. BB1 was not listed. This is the first retail mortgage listed in the PDEX. I'm sure things will give you more advantages, but I felt it enhanced liquidity. If they needed money, they could sell it. And if they sell it today, actually it was 104.4. They actually could have made money in a month. The bid and prices are available every day in the website of PDEX. And even if you live in the provinces, the LBP branches, 333 or whatever, going, they can act as buying and selling agent for you at a very low commission. Disclosure. I had mentioned that. I used to work for Land Bank before. And my daughter also. And Land Bank, again, if you don't want to sell it, but you need money, they will also allow you to borrow up to 80% of the current value. So you go to the internet, go to Bank's website, find out what the current market value is, go back to Land Bank and you can borrow up to 80% of the market value. Okay. So, and to make sure that they don't sell it and they keep it because of all these advantages, we look at the Filipino behavioral attitude of gambling in investment. So we put a little gambling. We said, if you hold on to your bond, thou shalt get one raffle ticket per month, and For example, this year on November, we will have a raffle. And if you win, you will get a house and lot in Dasmariñas, Cavite, 15 minutes from Lasal Dasmariñas, and you can rent it out to students. The approximate value of 450,000. And we will do it again in December 2012, December 2015, August 2017. So if you hold on until the very end, August 17, 2017, you get your interest, you get your money back, and you also have one last chance to. Anyway, so we felt that this was a very good setup, and it will make sure that our retail investors will hold on to it. They'll be mainstream into the financial system, etc., etc. And we were very happy also that because of the central bank regulation, the big brothers, financial institutions, the banks, will probably not be too interested in tumbling it up because it will be in their numerator. Anyway, 2 more slides, and then I will. Okay, what do we have in store for the rest of the year? Like Ian said, this is the housing map. Plug, something called the CMP bond is going to be issued by our subsidiary, Socialized Housing Finance Corporation. The asset pool will be about 2.5 billion CMP loan. We've done our pre-mandate. But by the way, don't take my word for this. I've gone beyond you trusting me. At extra expense, okay, we've gotten a portfolio auditor to review what we claim about the asset pool. That's very good accounting. Very bad. I mean, E&Y, no? They're also one of the big 4. Again, disclosure, that's my alma mater also, PricewaterhouseCoopers. They did the portfolio auditor. And we had Phil rating, do the ratings, even though it's a government, we didn't have to be rated. And they do the validation, and HCC also do validation. And there's a story of one of our valued, good paying client, I think in Bacoor, Cavite. And by the luck of the draw, pure luck of the draw, she was selected as sample by PricewaterhouseCoopers. So they went there, and everybody in the community said, oh, it's probably going to be foreclosed because there are people knocking in his house. And she was really very bad. But since only one, he didn't complain. But again, by the luck of the draw, when Phil Ratings was sampling, he was also selected. So again, another group of people went in interviewing him. And he was really annoyed. Why are these people coming here checking on me when I'm very current? Okay. And they had to explain we're doing securitization. And actually we selected you because really, okay, we were able to appreciate. But unfortunately, by the luck of the draw again, when HCC was doing their due diligence, she was selected again. So for in about 3 months, 3 groups of people were going to the committee. Probably, I think she prepaid the loan because she couldn't stand the public ridicule and embarrassment. Everybody in subdivision thought he was being foreclosed because all these famous people were. But that's the sort of due diligence we wanted to make sure. And whatever we issue, we will do the same thing. If it's not required, you will have a portfolio auditor. If Ian bids very low, we might even consider him. I'm trying to get very low. We'll have good rating agencies. I'm sure Nobel bids very low, we might even consider him. We'll still be listed, we'll still have the rating, and so on and so forth. By the way, this will be, it's called an alternative mode of compliance to Section 18 of the local Utah law. Okay? Why is that important? Okay, that law says to say every developer must, it's very similar to Agri-Agra law, those of you in banking, where you must give X% of your loans to agriculture. The UDA law says if you're a developer, 20% of your project must be socialized. Okay? It's easy to say, but it's difficult to implement. I was in not last week, I was in the Andrea conference 2 weeks ago, and the complaint of the developer was that, okay, they did the project, and they got the loan to do the socialized housing, but when they're trying to get permits from the LGUs, I will do it in Tagalog and I'll translate it later. Ano ba kami? Pagbakan kami ng squatter ng Metro Manila? Hindi. The LGUs would not like to give permits because they think that all of our informal settlers are being thrown to them, and what happens is when they're there, they're more expensive because the schools have to be, they will have tuition, they will have to have services. So even if you have the money, it's very difficult to meet that 20% socialized housing component. So if this thing comes to pass, okay, this will be either late this year, slippage early. Then this will be alternative compliance, and then a developer can actually buy this, and it will be alternative compliant, and it will be listed. So after he reports it to HLURB, he can actually then sell it the next day. It's listed, or etc. So it will be. I expect this will be probably very heavily oversubscribed also. This will be a proposed securitization structure. We will be involved. Will be like front end. So you don't have. They're not really that knowledgeable. So we'll help them talk to all the other people like and structure it similar to what we did for one. Okay, that's a lot of talk. So what have I done differently? What have I done that will make sure that what my daughter said will not come to pass, that I will not lead the Philippines down the same road as the US? And again, I go back to the best-selling book. So I will go to another section. And it's read, everyone then who uses words of mine and does them like a wise man who built his house on rock. And the rain fell, and the floods came, and the winds blew and beat on the house. But it did not fall, because it had been founded on rock. And my philosophy will always be, the underlying pool will be very strong, and you can rely that the underlying pool will not just rely on all the credit enhancement, but it will provide the cash flow for the investors. Thank you very much.